It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. Planning for retirement. I love this particular topic here, and I'd like to discuss this because Professor Rick Plum, certified financial planner, professional, this is what you do for a living, this is what you do every day, and this is what you enjoy. You come into work and you get planning with people, and so I'd like to talk to you about this kind of right in our wheelhouse. I'm Johnny Dean. This guy is Professor Rick Plum. I'm the podcast host, not an advisor, but I know a lot of advisors, and people like Professor Plum, believe it or not, you can combine a good and funny personality with a knowledge of finance.
Well, we do have some fun when we do it. I mean, we have to be able to relate to people. And there are times where a little humor really goes a long way because sometimes the planning process isn't fun.
You're right. And maybe we can get into some of that as well. On our way in here, two things. On our way in here to the studio today, we saw one of the people who does the kind of the nerdy
the paperwork?
Well, no. I'm saying that does the investing side. You know, analyst. Yeah. You know who I'm talking about, the tall guy.
Yeah.
Yes, yeah. That I won't mention his name. Doesn't matter. But
he is a certified financial analyst.
Right. Now, if you wanted to have a fun time with this guy and joke around the way we do, you probably wouldn't.
Actually, no. That gentleman, he's very quiet.
His name is Tom. We can say Tom.
He's very quiet. But he actually is very funny. But he's got that dry, kind of, it's quiet sense of humor. And if you want to talk baseball, he's the guy to talk baseball with.
Well, see, now I suppose he just walked past again. I suppose maybe I should have him on the show sometime.
We'll talk baseball.
Or talk financial.
But no, he's great, but he's not as outgoing, overbearing, so to speak.
No, and it fits the role. Now, you fit the role of the financial planner because you do have to talk to people. You speak with people. You talk to them about their retirement goals, which we're going to get into here today. You ask their questions, and you help to plan. Now, the other thing on our way in here today, and this actually works out very well with the topic, as we were walking through, somebody recognized you and said, "You're Professor Plum."
I saw your picture in the post office.
You had a nice side view and a front view.
Do they still do that at the post office?
I really don't know.
I haven't been to a post office.
I don't think so. They used to when I was a kid.
Know.
We kid, but at the same time, they recognized you because your picture is up on the hallway here. You and me were sitting in our studio, and they've heard us before, but they, I guess, hadn't necessarily seen you. And she asked a good question, and I want to pose this question to you because you had a good answer for her. Maybe we can expand it on a little bit. Explain what her question was, Professor Plum.
Well, in a general sense, the question was, should you be investing? She was talking about her IRA. Should you be investing lump sum if you can do 6,000 under 50, 7,000 50 or older? Should you do all 6,000, 7,000 at once, or should you do it on a monthly basis?
So if you get a big
and the reality is, it's where is the money coming from to do it, and it's if you have that lump sum, and this is not going to be an exact answer because we don't know what the future is going to be, but generally, putting the money in lump sum will do better than staging it in over the next 12 months.
Yeah,
if I have that lump sum.
Her situation was I guess she's a real estate agent of some kind, and she had gotten, her explanation was that she'd gotten some kind of a nice commission check. I don't know how much it was, but she wanted to know, well, do I take this? And I think it was an IRA she would talk about.
She was talking about funding her IRA.
Funding her IRA, and she said, well, do I just dump this all into the IRA? Or is it better for me to put it away in something safe and then, maybe divide it out over the next 12 months?
And from a purely financial standpoint, the answer is generally, not always, generally it works better to put it all in lump sum because if the market goes up, then all the money's in there working. Now, if the market doesn't go up and the market goes down, well, then that monthly thing should have worked better. And because we don't know which way it's going to go, historically it tends to go up more than down. So typically it's better to have it in there working for you rather than not. Now, on the other side, That's the financial answer. The other side of it is the stomach, the gut, the emotional. If you put in, this goes back to whether it's $6,000 or $60,000, you just inherited some money. Do you put it all? You've identified that the money we're talking about is going to be allocated to long-term growth. That's the first key. This is long-term growth money. We inherited this money. We're saving this money for the future. It is not money we're going to spend in the next several years. It is money for the future, down the line, quite a ways. So do we take that lump sum and put it all in today? Or do we stage it in over some period of time? IRA is obviously a year, but an inheritance you could take as long as you wanted to get it invested. And the answer is, what is your stomach going to do if you were to put in the lump sum today and the market goes down by 20% between now and the end of the year or whatever it happens? And you are Murphy's Law, and so you will control the market by your actions. You put the money in, the market's going to go down. How are you going to react to that? And so that has a lot to do with it.
Yeah.
In financial terms, it's probably better, or at least statistically better, to go all in for the money that you're going to be long term. The stomach may say, I want to do it a little bit differently. I want to go in slower just in case it goes down. Now, going back to Murphy's Law, if you put it all in up front, you are going to force the market down. If you stage it in over the next 12 months, 24 months, pick your number of months, the market will stay flat or go up. It'll go up real fast in the first couple of months and then stay flat after that. So it'll do the opposite of what you want it to do, just because you are Murphy's Law incarnate.
Now, if either of those scenarios do happen, and if it's long-term money, can you really be hurt by that? Does it matter over a period of 10 years, whether you...
10, 15, 20 years, it's probably not going to make much of a difference at all, as long as you don't react to negative issues.
No, if you left it alone.
If you just leave it alone, don't look at it, 15 years from now, the difference in whether you had staged it in or whether you put it in all up front probably will not be very much of a difference. It's going to be one, a little bit, a couple percent one way or the other. But the average investor doesn't do it that way. They tend to react instead of, holding on. And they sometimes, especially, imagine doing this January of 2020 and putting a lump sum in January of 2020, and then March, April happened, and all the news that looked so dire about the market in March and April of last year, you lost 20, 30% at that point.
Yeah.
Probably you're thinking, I need to pull it out before I lose even any more. And then it turned around like on a dime.
Mm-hmm.
And we had the sharpest V, recession recovery that I've seen in my lifetime. I mean, it was down and back up within a couple of months.
Right.
And so it has to do with how you're going to react to it. So the emotional side of it is an important to understand. You have to understand how you're going to react to what happens.
So you might hate it, you might not be able to stomach it, but if you don't do anything about it and you just try to weather the storm.
As long as you've identified that it's 15-year money, you are in the next 15 years, you're going to see at least one, maybe two significant downturns.
Mm-hmm.
The only problem is I can't tell you when it's going to happen. Wish I could. Wish I knew. Maybe I wouldn't tell you. No,
there's no way I would tell you, because if somebody looked and said, this guy's been right 100% of the time for the last 3 years, everybody do what he does, then it would stop working.
Right, because you're going to affect the market on its own.
Exactly.
But nobody's that good.
Well, we talk about putting lump sum in versus dollar cost averaging, which is doing the monthly thing. The dollar cost averaging part of it is really what we do with our 401ks.
Right. We're putting a systematic amount in on a systematic basis, a set dollar amount, or maybe a set percentage if your income varies, on a consistent basis whenever you're paid, every month, every 2 weeks, bi-monthly, bi-weekly, however it works. And so, the good thing, you don't even think about it, do you? It just happens. And
I don't even see the money.
Yeah, and after a couple of years, you look at, wow, my 401k is doing what? That's not bad. So,
well,
and the dollar cost averaging works because, and the bottom line answer to your original question is, you invest your money when it's available to invest. If I get a lump sum, I'm going to invest the lump sum if I've identified that it's long-term growth.
Mm-hmm.
If I don't have a lump sum, am I going to monthly save into a savings account so I can build up a lump sum to dump in it, once a year? No, I'm going to put it in monthly. So it's a matter of, where's the money coming from that I've identified that's going to be long-term growth? Is it coming from a lump sum? I'll probably do lump sum investing. Is it coming out of my paycheck every week, every month? Well, then I'll probably dollar cost average.
Well, it's interesting when you look at this. We go back to March, April 2020 when we saw that sharp drop, and it was sharp. It was quick and sharp, as you said,
and sharp recovery,
and a fairly sharp recovery within a few months. I would think we'd come back. But for somebody who'd been investing in their 401k all that time, they invested as the market went down.
Oh, it was wonderful.
And explain why it was wonderful.
Well, what happens
with
dollar cost averaging? I will say this: dollar cost averaging does not guarantee a positive result. We still need to have some time on your side. So if you get out too soon, you could have been investing while it was going down. But if something's $10 a share right now, and I'm putting $100 in, I get 10 shares. Well, if the market goes down by 10% next month, I'm still putting $100 in, but now I'm getting 11 shares
because it's cheaper.
Because now it's $9 a share, and then it goes down to 8, 7, 6. Maybe it goes all the way. It goes in half. Goes down to $5 a share. I'm buying 20 shares at that point because I'm still putting my $100 in, and then hopefully recovers back to where it started at $10.
And there's no guarantee it's going to do that.
And we're looking at a market, the S&P, the Dow, things like that, not just an individual stock, but it gets back up to $10. The money that I started with, the very first investment, I haven't made a dime on. I just recovered what I lost on that one. But all those ones, I bought a lot more shares. There were $10 shares that just recovered, but there were 20 shares in that example that doubled. And so what happens is you're averaging your transaction price to a lower number. You're buying a lot more shares when the market's lower and fewer shares when the market is higher. And so your average cost, your average transaction, your average purchase is less that way. I mentioned that earlier. Emotions can really screw up how we invest. Our ability to be irrational, it has no bounds.
Absolutely. And I have to admit that last year, in 2020, when I was looking at it, and I'm in my late 50s, closer to the 60 side than the 50. And of course, I'm looking at retirement. It's less than a decade away for me, 7, 8 years. And I looked at it and I thought, man, did I just mess up my retirement? I had a thought. I didn't do it, but my thought was, well, maybe I should go to cash. Maybe I should pull out, which of course would have been a dumb thing to do. That was my emotion. I wasn't going to do it, but that's what I thought. But because I didn't, when it came back because I have all these extra shares now.
It came back with vigor.
It really did, with vigor. That's right. There's a reference that nobody below age 70 understands.
But I know somebody who was, at the time, thought they were smart and went to a very safe cash-oriented portfolio right at the beginning of March. They saw the handwriting on the wall with the COVID stuff.
Was this before the real drop, I guess?
This was just when it was, kind of flattening out. It may have dropped a couple percent. They're saying, no, this is going to get ugly. They went to cash, and they were brilliant. They were strutting, man. They were smart. But the problem was, they whenever you do that, you have to be right twice. Now, they were right on the top side there, but you have to be right again on the bottom, and you have to get back in. They didn't get back in until it was higher than where they got out at. So they missed out on it. They missed out on some of the return they could have gotten by staying in.
Yeah, people don't think about that when you talk about things like market timing. Well, here's when you sell and here's when you buy. You have to be right twice, don't you?
When you're talking about growth assets, if you're saying I can time this, you have to be able to time when to sell and when to buy. And it's hard to time one, let alone two. I mean, we go back multiple times in history. I know that back in 2011, back when they were talking about the downgrading of the U.S. debt, a gentleman we both know got out in June-ish, I think it was, in the market
somewhere in the summer, and
August was when they downgraded it. Market went down 16% or 17% very quickly, and then recovered almost as quickly. And by the time that gentleman got back in, he missed out on about 10 or 15% of where he would have been if he'd stayed in.
And again, there you mentioned the emotion playing a role. One of the nice things about things like 401ks, which is this dollar cost averaging, the monthly, the systematic, is, as you said, you don't really know it. It's money that isn't that you don't see off the top.
Now, I'm a little weirder than most people, but I actually track my 401k on a daily basis and my IRAs, my portfolio on a daily basis. I don't do it because I'm looking at, oh, what did I make or what did I lose? I'm not looking at it from that standpoint. I'm looking at it from an overall standpoint of what's the market doing, what are other people feeling right now. So when people call in and talk to me about things, I know what's been happening with my assets, and so I have a feeling of what's happening with their assets. So it helps me relate a little bit more. And I will tell you that, late March, I stopped tracking. I didn't get out, but I stopped looking.
It was the old stop opening your bank statements, right?
I did not look at it again until I think maybe August. And by then it was like, oh, this is pretty. This is nice.
Oh, see, I looked. I had to. I
didn't change my strategy at all.
No, I didn't either.
But I did stop looking at it.
It made me question my asset allocation model because, I've set this 401k up for a while back. And as I said, I'm less than a decade away from retirement. And I'm still like 100 in this 401k. I'm still 100% aggressive growth. And it made me question whether or not that's a good strategy.
My 401k is 100% aggressive growth as well. I have some safe money elsewhere.
Me too, but
I'm getting within that 5 to 10 year window, and I'm
Yes.
setting up my buckets in other places other than my 401k because I'm obviously still contributing every paycheck. What we get paid weekly, WEAKLY. No, I'm kidding.
How many people work here? About half.
That's a good one.
Yeah. Well, so just to, as we were talking about lump sum, do you get a...
It's about when you have the money, as long as you're not going to be emotionally reactive to the market. If you have a lump sum to invest the lump sum. If you've identified that you have appropriate time horizon for growth. But don't try to build the lump sum on monthly investing or, paycheck by paycheck investing when you could be putting that in the market and dollar cost averaging. Because it's simple. And whatever makes it easiest for you to save is the best way for you to save. Systematic, I think, is one of the greatest things going. Set it up, set it and forget it for a while. And then every year or two, wow, am I saving money? I don't even notice it anymore. Bump it up. Save more. Yeah.
Well, that's another thing that we've talked about with 401ks, which is people who say, well, I just don't have the money. You could start off small. I mean,
right.
1% maybe if you want, right?
Well, I would look at whatever they're matching. Yeah.
If there's a match.
First off, is there a match?
A company match.
Second issue is, let's see if we can get that match because, hey, they're willing to pay you that money for doing your job, but you have to do a little bit to get it. You have to put some money in to get your match. Do what it takes to get the full paycheck. I mean, that's part of your pay package.
Here's something else. Just throw this out, and I don't know if this pertains to our listeners. I think it does to some. I've had this question before. What does a 401k match mean? I mean, does it mean that if I put in $200 a paycheck or whatever, that the company's also putting in $200? Can you give folks just a very quick explanation of how this generally works? Because what you hear is, well, they're going to match 50% up to
6%. That's a common
or whatever.
one.
Yeah. Can you explain that for people who don't understand how that works?
Well, the matching contribution is, yes, they're going to match what you put in to some degree. That 50% match means that if you put in $1, they're going to put in 50% of what you put in. You put in $1, 50% of that's 50 cents. So they'll put in 50 cents. They're going to only match, though, in the example you gave, 50% up to 6%. If I get paid $10,000 a month, and
just for easy math.
Yeah. Got to do the math now. Was that $600 a month?
$600 a month?
Yeah, 6%.
Oh, yes. Yeah. Well, yes, because 6,000 is 60%. Oh, man, we are bad.
So you're putting $600 a month in, and they're going to match you with $300, 50% of what you put in. But if you put in $1,000 a month, they're not going to put in $500. That's 50%, but it's over the cap. They're only going to match 50% of the first 6% of your pay that you put in. Now, for some 401ks, you do have to be a little careful on this. Some will only match on a per paycheck by paycheck basis, whereas others look at the entire year. So some people like to get their 401k fully funded. Let's say you want to do the full, 19.5 now. And so you start off by putting $2,000, a month away. So in 9 months, basically, you're going to be fully funded. But you're putting in a lot more money over and above what they might match. So they may only match the first X%. And then the last 3 months of the year, you're not putting any money in. So you're not getting the match in that year or in those months because they match on a paycheck by paycheck basis. So unless you have money going in on every paycheck, you're not getting the match for the year. Others will go back and say, well, they maxed it all out in the first half of the year. We're going to true it up and give them the match, or we're going to match it, all the way. But it's a funky little thing going on in the way math works and the way that they match. Is it a paycheck by paycheck match?
Or is it a full
or is it an annual basis
year
where they match based on what you put in for the year? So so you want to know that because it only matters to people who are funding for partial year, setting it up and putting it all in early, or stopping stopping halfway through the year. So it depends on what's going on. Some people will change their allocation through the year because maybe they've got expenses at a different year. But if it's a paycheck by paycheck match, then you want to have a contribution on every paycheck so that you can get that match.
But you have to ask whether it's a paycheck by paycheck or over
Most
an annual?
of them, I don't even know what the averages are.
That?
Ours isn't paycheck by paycheck, by the way. They will true it up for people that,
Now it doesn't matter because I'm putting it in all year. So
yeah.
So, but it isn't paycheck. It isn't.
They'll true it up for somebody. Years ago, 2008. 2009, we had a gentleman worked here, and he saw the handwriting on the wall, and he said, 2009, the market was just crashing.
Yeah.
In 2009, now he had a spouse that worked, and they could live on one income. They'd set themselves up very well. And so he basically was putting his entire paycheck towards the 401k until he maxed out in the first couple months of the year. I mean, he put it was like $15,000 back then or whatever the number was.
And he was getting a match.
And so he put it all in, but then he didn't put any money in. He wanted to dollar cost average on the way down. He saw the market going down. He wanted to get it in as soon as he could, and he maxed it out by about April or May, I think, something of that nature. So he was buying in January, February, March, April, May, and the March 9th was the bottom of the market at that point. So he did
2009.
2000, that was back in the day when we had that crash. But his match, if he had done that way, if it had been a per paycheck by paycheck match, he wouldn't have gotten the whole match because he didn't contribute anything for the last 8 months of the year.
Well, plus he was when he put in the paychecks, he was way over.
Oh, he's putting 100% of his pay away, which is more than 6.
That's interesting. Well, so what if this could go to somebody who's retiring, not just see the market crash because most people can't see that. But if you're going to retire in June, say June 1st or July 1st, you got half the year, and you get a match. I guess how do you know if it's better to,
by that
try to do a full year's?
Well, I mean, that time you're less worried about the match and you're just more worried about getting the heck out of Dodge.
That's true.
Sorry, that's just what I've seen. So
no, that is true. I just didn't know how often that situation.
Well, and it also depends because there's the matching contribution is they put in based on what you're putting in, but there's also a profit sharing contribution at times. Not all of them do this, and you have to be employed on a certain date to be able to get that profit sharing. So if you have a company, if you work for a company that puts a profit sharing contribution, whether you put money in or not, they put in X% of your pay at some point in the year, but you have to be employed on a certain date to be able to get that. If you're getting ready to retire, know when that date is.
So that you can receive that.
I mean, if you're thinking about retiring June 30th, but the cutoff date is July
September
30th,
1st.
well, maybe you work an extra month to get the profit sharing matched if it's a decent one.
I hadn't thought of that.
If on the other side, you're looking to retire December 31st and you have to be employed on June 30th, it's like, well, I'm not working another 6 months for that. But if you know those dates, you can, and you know what your match has been or what your profit sharing contribution's been, is it worth me working another month, 2 months, 5 months, 6 months to get that X amount of dollars?
Well, if that pertains to you, fine. The one last thing, we talk about maximums. The maximum contribution to a 401k for this year, and this I am saying 2021 for people who are listening now. There is a catch-up provision. Let's talk very quickly. What are the maxes for?
Well, the contribution limit for a 401k is $19,500. That's for everybody, but there's a special catch-up additional amount that those of us seasoned citizens who are 50 years of age or older during the year.
We're about to get mustered out.
Yeah.
Yes.
Relish that
I
idea.
relish these conversations, right?
People are going to say, I thought you said they were funny.
I'm going to say everything's funny,
So where were we?
Okay, so you said there's a catch-up provision.
For people 50 years of age or older, you can put an additional $6,500 in for the year. Now, it doesn't matter what time of the year. It's just with a 401k, if you're an employee, if you get a salary, you're getting a paycheck, it does have to come from the paycheck that's being paid during that year. So you want to make sure that if you're trying to max out, and for somebody who's turning 50 this year, maybe they turn 50 in December. And they say, well, I'm not eligible for the catch-up until December, and I can't afford to put in, $6,500 in December. Well, it's the year that you turn 50. So you can start that extra, savings amount, to max it out through January. So you could take the $26,000 total combined, divide it by however many paychecks you get paid, and start that in January and max it out for the year. You don't have to be 50 to start the catch up. You just have to be 50 during that year. And
these are contribution, the employee contribution.
Contributions.
That has nothing. The match can actually put you over.
The match is another amount that the company can put in addition. And as long as your contributions and the company match don't exceed, $58,000 this year without including the catch up, you're going to be okay. If only your company would kick in that much.
I'd be happy to reach that. I'd be happy to reach that. And now,
for self-employed, that is an issue, though.
Well, that's true. That's true. They do need to know that if they're. That's true. One more last thing before we close this out. This comes up to, and a lot of people still aren't aware of this. We're talking about 401ks. We're talking about
403bs,
403bs, and things like this. You can. I was talking to somebody just 2 weeks ago who didn't know this, and a guy who's fairly well connected in the finance, how you can remove money from your employer's retirement plan if you're age 55 or older and you've severed employment from that company.
Being able to access. Some people understand age 59 and a half. I've got to get to 59 and a half before I can draw money out of my IRA without a penalty. Now, it's going to be taxable whenever you take the money out, but I don't want to be penalized. And so people think you have to work or have to wait until 59 and a half at all times to get money out of a tax-deferred account.
And that's when you're actually 59 and a half, not the year you turn.
That's the day you turn 59 and a half or later. And there are ways to get money out, even from an IRA, if you do a substantial equal payment plan, which can be a pain in the backside. But if you are working for a company where you have a company-sponsored retirement plan and you sever employment for any reason, terminated for cause, quit on your own behalf, whatever the case may be, you get downsized.
You got arrested like Charlie Sheen in.
I think he's 55 now. No, if you are terminated or sever, we'll call it severing employment.
Yeah.
In the year you turn 55, and this one's the year, not the date, but the year you turn 55
or older,
or older, you can take distributions from that company's retirement plan without paying a penalty. And now, if you roll it to an IRA, now you're not taking it from that company's retirement plan. You're taking it from an IRA, penalty 59 and a half. If you retire before the year you turn 55, just waiting until 55 doesn't get it there because you retired before you turn 55, the year you turn 55. Now you got to wait till 59 and a half. If I have multiple employers, 401ks that I've never rolled over and but I left them long before I turned 55, they're all 59 and a half. It's only the employer that you terminated from in the year you turn 55 or older that you can take distributions from without a penalty. Still taxable because
can't get away from that.
Yeah, death and taxes.
Even your heirs can't get away from that tax.
But there are ways to get away from the penalty. So if you're looking to be a somewhat early retiree, 55, 56, 57, and you have money in a 401k, and you're saying, well, how am I going to bridge the gap from 56 to 59 and a half when I can get to my tax-deferred money? Make sure there's enough. First off, make sure your employer allows for distributions, because the employers can be more restrictive. The law says you can do it, but the employer, with today's computers and everything, the employers will let you do it. But some of the older style ones still say, we're not going to send you any money. We're not going to, you either roll it over or, leave it here. But
really? I did not know that.
Every once in a while we'll run into that. There are some plans that are fairly restrictive.
So they don't care about whether you pay a penalty. That's on you. They just won't send you the money?
Right. It's
You
just
have
not-
to roll it out of the plan?
Yeah, the TSP, the Thrift Savings Plan, was kind of like that up until a couple of years ago when they opened some flexibility. They were very inflexible.
Well,
They've recently added some flexibility to that.
Yeah.
There is a very large provider, retirement plan provider. It's basically 4 initials, and we won't get into it. But they, depending upon the plan that your company signed up with, and it's usually a school district or a hospital district or something of that nature, they are notorious for not letting money away very easily. It's tough to deal at times with them.
I'll have to ask you about that off the air.
Yeah, but as long as your employer allows it, and you can take distributions directly from that employer's retirement plan, you avoid the penalty. So if you need, $50,000 a year, from your investments, you're retiring at 56. Make sure you leave $200,000 in the retirement plan so you can draw $50,000 a year out, at least that much. I'd leave more there, just to be able to get to 59.5 when the rest of your assets open up.
That's great. Yeah, it's just good to know. And I think some people aren't necessarily aware of that. We've been talking about the whole idea of lump sum or dollar cost average if you have an option to do that. Once again, you say it's better if you have the lump sum to just dump it in.
From a financial standpoint, to dump it in. From an emotional standpoint, you may want a dollar cost average. Understand, though, that if the market goes up, you miss out. If the market goes down, you won. And
over a long period of time,
it's going to make a minor difference.
Then the longer period of time you have, the less of a difference it's likely to make. If you want to talk more with Professor Rick Plum, you can do so. 800-644-1150, the number at Lucia Capital Group. They do this stuff all the time. This is all part of the planning process. When should I take money out? What do I do with a lump sum? As we saw, somebody just cornered Professor Plum about an hour ago before we started this podcast and wanted to know the same thing. It's all part of the planning process, and it's what financial planners do. 800-644-1150, talk to Professor, or actually any of the Lucia Capital Group advisors. You got a whole team of people that do this.
Oh, yeah. Lots of certified financial planners, lots of advisors. Some CFAs if you really want to get nerdy on that stuff, if you want to talk like that.
Chartered financial analysts.
Is it chartered financial? Yeah.
I think it is.
Yeah.
Do I have it right?
I know it's analyst.
It is an analyst, and they will analyze. Not sure you could try to joke around with them, but they're pretty serious folks. Anyway, 800-644-1150. You can also go online. You can send Professor an email or the entire Lucia Capital Group staff, Lucia Cap, LUCIACAP, LuciaCap.com. Find articles there. And by the way, don't forget to subscribe to our podcast. If you're a new listener, we appreciate you doing this. We get a lot of new listeners every single month. And if you want to subscribe, go to Spotify. Do that on Spotify, and you can get these podcasts download right to your device. I appreciate you being here. My thanks to Professor Plum.
Thank you.
And to our person out in the lobby. Whoever she was, asking questions like this, because, hey, if you have questions, go ahead and email us. We'll be happy to talk about them if it's relevant. We will talk to you again next time. For Professor Rick Plum, Certified Financial Planner Professional, I'm Johnny Dean, podcast host. Thank you so much for listening, and we'll talk to you again next time.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy, including the investments purchased and/or investment strategies devised by LCG, will either be suitable or profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the presentation or any component thereof serves as the receipt of or a substitute for personalized advice from LCG or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. When considering a 401k rollover to an IRA, it is important to consider and compare investment-related expenses for your employer plan, a new employer plan, as well as for a new IRA. This comparison could include plan administrative fees, service fees, sales loads and commissions on the underlying investments that the plan or the IRA may incur. Please contact your financial professional for more information. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. A dollar cost averaging strategy does not guarantee a profit or protection from loss. Since such an investment plan involves continual investment in securities regardless of fluctuating price levels, you must consider your willingness to continue purchasing during periods of high or low price levels. S&P 500 Index is an unmanaged index and includes a representative sample of large-cap U.S. companies in leading industries. An investment may not be made directly in an index. The Dow Jones Industrial Average is a price-weighted average of 30 significant stocks traded on the New York Stock Exchange and the NASDAQ. The DJIA was invented by Charles Dow back in 1896. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.